Effective cash flow management is crucial for maintaining financial health, whether you're managing a household budget, running a small business, or handling your personal finances. Cash flow refers to the flow of money into and out of your accounts, essentially focusing on how well you balance your earnings against your expenditures. Without proper cash flow management, you could face difficulties in paying bills, covering unexpected costs, or keeping your business operational. In today's video, we'll cover practical and straightforward techniques to help you manage your cash flow effectively and prevent the stress of running low on funds. To begin, it's important to grasp what cash flow entails. Simply put, cash flow is the difference between your income, money coming in, and your expenses, money going out, over a certain period. Positive cash flow occurs when you have more income than expenses, while negative cash flow means your spending exceeds your income. Effective cash flow management involves ensuring you have sufficient funds to meet your expenses, save for future needs, and invest in opportunities. Now that we've established what cash flow is, let's explore some actionable strategies. 1. Create a budget. The first step in managing your cash flow is to establish a budget. A budget serves as a financial plan that outlines your anticipated income and expenses over a set period, typically a month. By creating a budget, you gain a clearer understanding of where your money is going and can make necessary adjustments. Start by listing all sources of income, such as your salary, any side jobs, or other regular payments you receive. Next, list all your expenses, including rent, utilities, groceries, transportation, insurance, and entertainment. This comprehensive overview allows you to see where your money is allocated and identify areas where you might be overspending. For instance, if you find that a large portion of your income is spent on dining out, you might choose to reduce this expenditure and redirect those funds towards savings or debt repayment. A budget not only helps you track and control your spending, but also ensures you are living within your means and prioritizing your financial goals. 2. Track your spending. Creating a budget is just the beginning. Tracking your spending is crucial for staying on track. It's easy to overlook small purchases, but these can accumulate and disrupt your budget. Use a spreadsheet, budgeting app, or even a simple notebook to record every expense, no matter how minor. Regularly reviewing your spending will help you stay aligned with your budget and make necessary adjustments. For instance, you might discover you're spending more on daily coffee or subscription services than you realized. Tracking these expenses allows you to assess whether they're justified or if you should cut back to improve your cash flow. Consistent tracking also helps you identify spending patterns and pinpoint areas where you can save. By keeping a close eye on where your money goes, you can make more informed decisions and maintain better control over your finances. 3. Build an emergency fund. An emergency fund is a crucial component of effective cash flow management. It acts as a financial safety net, allowing you to cover unexpected expenses like medical bills, car repairs, or job loss without falling into debt. Ideally, your emergency fund should be enough to cover 3 to 6 months of living expenses. Begin by setting a manageable goal, such as saving $500, and gradually increase this amount over time. Having an emergency fund not only shields you from financial stress, but also provides peace of mind, knowing you're prepared for unforeseen costs. To avoid the temptation of using this fund for non-emergencies, keep it in a separate account from your regular checking funds. 4. Prioritize your expenses. When managing cash flow, it's important to prioritize your expenses to ensure you're covering your essential needs first. Start by addressing necessities such as rent or mortgage, utilities, groceries, transportation, and insurance. Once these essential expenses are covered, you can then allocate funds towards savings, debt repayment, and discretionary spending like dining out, entertainment, and hobbies. If your income is limited or inconsistent, prioritizing becomes even more crucial. You might need to reduce or postpone non-essential spending until you have a stable financial foundation. By focusing on your most critical financial obligations first, you maintain positive cash flow and ensure that your essential needs are consistently met. 5. Cut unnecessary expenses. One effective way to enhance your cash flow is to eliminate unnecessary expenses. Start by examining your budget to pinpoint areas where you can cut back. For instance, consider canceling unused subscriptions, cooking at home instead of dining out, or making a grocery list to avoid impulse purchases. Also, evaluate your utility bills. Simple actions like turning off lights when not in use, using energy-efficient appliances, and reducing water consumption can lead to significant savings over time. By trimming these expenses, you'll free up more money for savings, investments, or debt repayment, ultimately strengthening your cash flow. 6. Increase your income. While reducing expenses is crucial, boosting your income can have a substantial effect on your cash flow. There are several strategies to increase your earnings. Take on a part-time job or start a side hustle. Sell items you no longer need. If you're employed full-time, consider asking for a raise or seeking career advancement opportunities. Invest in your skills and education, such as taking courses or earning certifications, to open doors to higher-paying job opportunities. By enhancing your income, you'll have more resources to cover your expenses, save for future goals, and invest in new opportunities. 7. Plan for irregular income. If you have an irregular income, such as from freelancing, gig work, or commission-based sales, managing cash flow can be challenging. To handle these fluctuations effectively, it's essential to plan ahead. Start by setting aside extra money during high-earning periods to cover expenses during slower months. This practice, often referred to as income averaging, helps stabilize your cash flow and ensures you have funds available throughout the year. Creating a buffer account with a few months' worth of living expenses can also provide financial stability. This account serves as a cushion, allowing you to cover bills and essential expenses during lean periods without dipping into savings or accruing debt. By preparing for income variability, you'll be better equipped to manage your finances smoothly, regardless of income fluctuations. 8. Use automation to stay on track. Automation can be a valuable asset in managing cash flow effectively. By setting up automatic payments for bills, savings, and investments, you can ensure that your financial obligations are consistently met without the risk of forgetting or overspending. For instance, you can automate transfers to your savings account each payday, ensuring you're consistently putting money aside without extra effort. Automatic bill payments can help you avoid late fees and penalties that could strain your finances. Similarly, automating your investments ensures regular contributions to your retirement or investment accounts, facilitating steady wealth building over time. Embracing automation helps you maintain financial discipline and frees up time to focus on other important aspects of your life. 9. Plan for the future. Managing cash flow effectively involves not only addressing immediate expenses, but also planning for future financial goals. Set long-term objectives such as saving for retirement, buying a home, or funding your children's education, and incorporate these into your budget. By planning ahead, you'll be better prepared for life's financial challenges and opportunities. For instance, if you're aiming to buy a home in 5 years, start setting aside money each month specifically for that goal. Planning in advance helps you take advantage of compound interest, reduces the need for loans, and avoids the stress of scrambling for funds when the time comes.